Welcome to Know Your Options, the Measured Risk Podcast.
The ultimate guide to navigating the volatile nature of the markets while managing risk purposefully.
Join us as we challenge the theory behind traditional asset allocation and dive into the mathematics of investing.
Whether you are a seasoned investor or just starting out,
this podcast offers valuable insights and practical advice to help you make informed decisions and manage your money wisely.
So grab a cup of coffee, sit back, and let's dive into the world of calculated risks together.
All right, well, good day. This is Larry Kriesmer with the Know Your Options podcast. I'm here with my business partner, Bernard Surovsky. And today our guest is Michael Clanin. He's with Safe Money Solutions. And Michael's had an interesting past of going through being a financial advisor in the regulated sort of security side of things and has transitioned over into remaining as an advisor, but in the, let's say, more of the guaranteed products or insured products universe. And we're going to talk today about that journey and about how we share some similarities and approaches that are sort of complementary and see how this impacts clients. So, Michael, welcome to the show.
Hey, Larry, thank you very much. I'm glad to be here with you and Bernard.
So I mentioned a little bit of your journey, but why don't you just explain in your own words sort of how you got to be here with the company that you currently have?
Right. Well, 20 years ago, I was a teacher. Believe it or not. I was an elementary teacher, loved it. It wasn't a job, and then it became a job. And I was always one of those that, I saw these older teachers who felt like they could never make the transition because they put too much time into it. So they were making their kids miserable because they had to be there versus they probably shouldn't have been there. And I always said, if I got to that same position and I wasn't enjoying it, I would make the transition. Let alone did I know that transition would be working with teachers through the Teacher Association on their retirement plans, the 403Bs. And I tell people the worst people to work with, to be honest, are teachers, because teachers are thinking about today in the classroom, right? Little Johnny, Susie, what issues they're dealing with today, let alone are they looking at 20 or 30, 40 years down the road. So I did make the transition of working with pretty much anyone. And I went to MetLife and I was there. And actually prior to MetLife, I was independent, working with teachers. And then I made the transition to MetLife where I was working with, other individuals outside the teaching. And then I ended up going back independent because I didn't like being structured on telling what products that I could represent. I like clients to have choices based on their current situations and that. And I was in securities, but, I got to the point, Larry and Bernard, I didn't like losing clients' money that I wasn't in control of. I'm at the mercy of the market, just like clients. So I did make the transition where I no longer hold that license to lose people's money, like a financial advisor and that. So I am primarily just insurance-based products, which explains Safe Money Solutions. Everything I do is about guarantees without the market risk.
Yeah. So we have an interesting background then. That's why I mentioned on the lead in here, because both Bernard and I started in our business as life insurance agents. And that is kind of you specialize in risk shifting. There's a certain amount of risk you take that is self-insured. I'm not going to insure a $10 movie ticket and pay $1 in case I lose it. That's just that I'm going to self-insure the risk that I'm going to lose my $10 movie ticket. But if I've got a $1 million home, I'm going to probably pay attention to what it takes to insure that because the risk of loss is too great. So this concept of risk sharing is right in your wheelhouse, or risk shifting, and you kind of want to shift risk where you think it is appropriate, and self-insure where you think you don't. So that was kind of our initial training. And we share your pain about the financial services thing where you have clients call during a market correction and ask a question, simple question. It's the question that most advisors still today have a hard time answering. And that is, well, how much worse do you think it can get? Or another version, how much more do you think I can lose? And the reality is that many years ago, we didn't have a good answer for that. for that question.
Mm-hmm.
That was an uncomfortable place to be because it was, well, just couldn't answer. If you build a net or an allocation of stocks and bonds and ETFs and all manner of things, including real estate, hard assets, other things, and things start to go down in value, then really there isn't a way of saying it's going to be another $43,600. It's just kind of historically.
Well, it wasn't delayed.
Yeah, there was.
It wasn't. We never had access to it.
Right.
Right. So why don't you talk about, let's say, the mechanics of, I know there's two basic products, right? Annuities and life insurance that you're using.
Mm-hmm. Correct.
So,
those primarily, yes.
And broad strokes, you don't have to mention company names, but broad strokes, let's say what's the core piece or the two components? And you have life insurance and you have annuities, and what's the main things you're using there?
Well, so most of my clients do come to me, either they're close to retirement or in retirement already. Right. And where do most of these clients have most of their monies? It is in retirement plans, 403Bs, IRAs, 457s. What's the other one I'm missing? Simple IRAs. They're in pre-tax vehicles. Right. And all they've done is they've delayed the taxes for future. Right. And the thing is, what are taxes going to be in the future? That's when reality is going to hit them. And in essence, based on our economy, our deficit, right? There's only two ways to reduce taxes. Number one is for the government to stop spending. That's not happening. Okay. And then the other is to increase taxes. So basically people are delaying, they're getting a little tax break today only to pay more in taxes to get back less tomorrow. And when is the dollar bill the most valuable? It's today. The dollar bill will be less because think of the candy bar, right? You used to buy a candy bar for 50 cents. Now it's $1 to $2.50, right? But the thing is, where people have their money, it's where the masses put their money because that's all they know. And just because everybody puts their money in these tax-deferred vehicles, that's the only place they know. They don't know that they don't have to risk their money to make money because they aren't having the conversations with people like me, because there's not very many people like me that this is their focus and that. So, but in a nutshell, most of my clients come to me and I'm transitioning them to get income because that's our focus, right? In retirement, for example, it's not about a return on your money. It's a return of your money. And my goal is with annuities, first of all, there's different types of annuities, as you guys are aware of, right? The types of annuities that we focus on are going to be fixed or indexed. We're not doing variable annuities. Those are the ones that have the bad rap, high fees, high risk, and all these bells and whistles that retirees don't need to be in the market. And I'm not saying retirees should not be in a market, but most of them should not have a large chunk in the market, because they're playing by the same rules that they did during their working years that they're doing in retirement. But those same rules are not going to get them to the end game. Either they're going to run out of money, they're going to risk their money. And my job is, how do we put our own private pensions into place that you can never run out of income? Okay. And with annuities, you can run through your money. But the thing is, the insurance companies are on the hook to continue to pay that income, just like a Social Security, just like a pension that they may still have for both spouses will continue to get that income. And if there's anything left over, then it still goes to the beneficiaries, right? So that's kind of the first thing is it's all about cash flow and that. And then the life insurance comes into play because I give my clients permission to go through their money. But we have life insurance that's meant for different benefits, mostly living benefits, which I can get into, but it's also to replace for legacy for kids, grandkids, charities. Okay. So kind of in a nutshell, that's kind of what I do. I take the risk off of my clients 100% as much as possible and put it on third parties, AKA insurance company. What I tell clients is you don't have to love insurance. I don't love insurance. You just have to love what it does.
So, Michael, So
Yeah.
explain to me a little bit of like, how will you structure something to provide for, you've made a passing reference to inflation with the candy, being 50 cents and now it's like $2.50 or whatever it might be. How do you address the issue of, the inflation bogey that's, it's always there. It's just a question of how big it is, right? I mean, right now, last year it was 7%. This year we're tracking at something, 3.5%. It's
Right.
still a number, even a 3% number, 10
Correct.
years down the line, it's 30%.
Well, let
So
me
how
give
do you address
you an
that?
example. Yeah, so let me give you an example. Because all the planning that I do takes risk off the table. It takes inflation off the table. It takes market risk off the table, legacy risk off the table. I mean, it takes everything off the table. So let me give you an example of an individual I'm working with right now. Okay. She has a pension and she has an annuity that's giving her $55,000 a year right now. Okay. Now, the annuity that another advisor put her in was only a 10-year payout. So her income is going to go from 55,000 down to 30-some thousand in about 7 years. Okay. By repositioning her assets, taking it out of the market and putting it in indexed annuities that provide guaranteed income within 30 days of that contract being in place, within 30 days, usually it's quicker. Could be 7 days, but I always tell my clients 30 days, right? Because there can always be hiccups. Her income currently will go from 55,000 to 180,000. So an increase of 125,000 instantly because we took it from one pocket and put it in another, and she will get that 125,000 for the next 7 years. But after that one annuity drops off in 7 years, she'll still have an income for the rest of her life that will be 160,000. She will go through her money, right? Because what comes out of those annuities first is her money and any growth. She will go through that money in, I think it's like 13 years. But the insurance companies are on the hook. If she lives to 100, they still have to pay her that. I believe it was 113,000 guaranteed for the rest of her life. We just built in inflation, way more inflation than inflation will ever go to. Right. But we've taken the risk off of her. Now she has a peace of mind. I can go do other things. And we can do other things with that money because does she need that money? No, but we can protect her in other areas. So I'm a holistic planner. I'm looking at all the risk in areas that I don't even practice, but I bring in other experts, right? So I'm looking at her auto and home. Does she have the appropriate coverage? Because what are most people focused on? What am I paying, right? I want to pay the lowest, which is fine, but until you need it, right? You want everything in place on the day you need it, including life insurance. Life insurance doesn't mean anything unless it's in force on the day you graduate.
That's a great expression. I think we've always felt the same way that no one cares about what type of life insurance policy you had, whether it was whole life or universal life or indexed universal life or some kind of term insurance. They only care about how much you had in force on the date of death. So
on the date of graduation.
Right.
Date of graduation.
Right. So you got to realize everything I do is against the norm. I'm going against the grain, right? This is too good to be true. How can the insurance company guarantee me this income even when I drain my account to zero? And that's the airbags. That's the insurance wraparound, right? Because just like auto and home insurance, not everybody's having a car accident. Not everybody's house is being burnt, right? It's a pool of money, right? Not everybody is collecting income from their annuities at the same time.
Well, if you're a novice listener or you're maybe not an advisor listening, it's pretty straightforward. You have the life insurance companies have two channels that they're insuring against. Short life is life insurance, and they make a payment if someone dies prematurely. But they make out well if someone lives a long life because they continue to pay premiums or they continue to receive fees for people who live longer than life expectancy. And then on the corollary, they also then turn around and hedge that risk with the annuity payments because annuity payments are paid out with the expectation that you live a certain amount of time. And a certain number of those people who buy those annuities will die early. And the insurance company makes money there and uses it to offset their cost of life insurance death benefits. So it's a perfect hedge for them. Right. And they're just taking from one pool to the other. And it leads into really what Bernard and I found as a solution to this sort of risk idea. It's because of the way the structure of these annuities work, particularly indexed annuities. Again, how these things are built in very simple terms. Let's say $100,000 deposit, maybe $95,000 goes into a zero coupon bond, which is bought at a discount. It's going to mature, let's say, a year from now for $100,000, and it leaves the insurance company with $5,000 of excess capital. And with that excess capital, you purchase an option, derivatives, basically, on whatever index that this thing is tied to. And at the end of 12 months, the insurance company either they'll have the $100,000 of the zero coupon maturing, which is guaranteed, typically through treasuries or some other bond portfolio. And then they have something or nothing. If they have a negative market, then they don't get any add back from the option. But if they have a positive market, they can add something back on top of that principal. So that's the basic structure that Bernard and I ran into years ago, probably 15 years ago, and said, wow, eureka, we can spitball this into something that has a little different flavor. And so what we've done with Measured Risk, our core company, Measured Risk Portfolios, is we deconstruct that equity indexed annuity into its moving parts. And instead of having a zero loss limit, we actually allow each client to determine what amount of risk they're willing to take. So if they want to lose, or again, license to lose. So I like that idea. For us, it's like an agreement to lose up to, let's say, 5%. So if you want to lose 5%, then we don't have to invest 95,000 of the 100. We only have to invest roughly 90 of the 100. And that allows us to buy twice the amount of options that the insurance contract does, because we're only agreeing between the client and ourselves to earn ourselves back to 95,000. But in so doing, we put a bunch more engine into the risk side of things. And you can continue this and say, well, if you're agreeing to lose 10% in a given, let's say, 12-month period, then we only have to invest maybe $86,000 into the zero coupon bond. That gives us $14,000 to invest in options. And this just continues to whatever risk level it is that the client wants. And what that does in risk shifting is that along the way, instead of like a point-to-point structured note or a buffered ETF, those kind of things, we manage that risk component on a daily basis, so that as the market's rising, we'll experience profits from our options typically, except that they're tied to the market. And we will sell that option contract and take the profit from that option contract and move it into treasuries, and then re-roll the remaining capital into a new option tranche and continue to basically raise the bar behind the growing markets, so that when there is a subsequent rollover and the market does sell off like it did in 2022, then the losses are limited to the amount of capital we have in the options. And they did lose their capital last year. But what's, I think, unique to our firm and our strategy is that the losses are limited to the amount that we know going in. So the part that got squirrely, and I'm sure you experienced it as an advisor, before when you were registered in the equity side of things, is the discomfort that comes from losses is predominantly because we don't know how big the losses can get. And so what we've done is not eliminated losses, we've just contained them. We've boxed them. And we know going into...
And defined them.
And defined them, right, exactly. So there's a tremendous amount of clarity that occurs with our clients in a drawdown. It's disappointing. We can't say we're excited about having the portfolio go backwards. But in exchange for that known amount of risk, we have a tremendous ability to move the portfolio positively. So when you have a year like 2019 and 2020, and wow, that was a crazy year.
Yeah, that was good.
I would have never thought in 2020 that we would have ended the year positively and so positively. Right. And so those are years where we get, significant double-digit returns. And so that's been our approach, but it's come from taking the playbook from the insurance side of the business.
Yeah. Mm-hmm.
And where I've always thought it'd be interesting is, and this just is more on a client by client basis, but you could accomplish that same thing by using like a fully funded life insurance policy as part of that treasury basket and accomplish some of the legacy planning we have. in our own client base a significant number of clients that have living benefit riders on their annuities and have that guaranteed income component. So we have those pieces that are, you just can't accomplish it any other way than with an insurance contract, being able to be sure of what the income need is. So when you're, as you look at an overall client allocation, do you want to try and get clients entirely out of equities as they get to retirement, or what's your feeling there?
Well, that's a great question, because first of all, there's a couple things. When I'm with a client, let's just say they're $1 million client, right? They have $1 million in the market, right? That's where most of their money is, of course. And I'll always ask them, okay, you have $1 million here in your, whether it's non-qualified, qualified, it doesn't matter. How much of this $1 million do you not want to lose? And what do they say, you think, guys, every time?
Yeah, right. All of it. We don't want to lose any of it.
Right. We don't want to lose any of it. Then why are you in the market? I'm just saying, why do you have a bulk of it in the market? Part of it is that's all they know, right? They don't know any differently. They don't know there's other options. And that. And with the annuities, I've talked about the income play, because annuities can be used for multiple things: income play and growth. Because there's some people that don't need the income or don't want the income. They want it to grow, right? And with index annuities or fixed annuities, first of all, fixed annuities, we already know what they're going to get at the end of 5 years because it's already fixed. If it's 5%, we already know with 100,000, that'll be close to 30,000. We already know that. It's like the insurance version of a bank CD.
Right.
Okay. Index annuities, because they're not participating directly into the market, but the index annuities use indexes as a benchmark. So if that index goes up, their account goes up. So think of going up steps. You can only go up the stairs. And if there's no growth or a negative, you stay on that step that year. Otherwise, if it goes up, you go up the next step, right? So you can never go backwards. And that might be similar to, again, I'm ignorant on options in that. I've never understood myself, even as a financial advisor, because I wasn't a Series 7. I think you have to be Series 7. I don't know. But anyway, I never understood those. And therefore, I never did them. But I don't think I wasn't licensed to do them either. So, and so there's different reasons for different products. But the thing is, being independent, it's all about the client. I want to put the client in the right thing because it fits their situation. I'm not trying to pigeonhole them into something that everybody else, like being captive, trying to get everybody in the same thing, but it doesn't fit, but yet I'm still putting them in that. That's not me. I like freedom. I like choice, and I want my clients to have freedom and choice, right? If we're talking about income, we don't care what carrier it is. We just want the carrier that's going to give them the most income for the rest of their life.
Bernard, talk about, we have an income solution that is variable.
Yeah.
So, and it's actually Bernard's baby, so I'll let him talk.
For our income solution, interestingly, we believe that there's three basic human needs. There's the need to eat, the need to use the restroom, and the need to procreate. And it kind of leads to, if you buy companies that service those three needs as their primary purpose for existing, and you look for companies that have a history of increasing their dividends and, pay dividends and increase those dividends, over time, your income just kind of stays, keeps ticking along. One would reasonably expect that it will keep up with inflation. And, when I've looked at that historically, it tends to just keep up and actually exceed inflation. So you don't really have to worry about inflation and just this constant increasing income. But it doesn't mean that the value of the portfolio stays steady. That's obviously going to be a variable.
Right.
But that's a portfolio that's based on, three basic human needs of, the three things. If we stop doing any of those things as a species, we cease to exist. And if you stop eating, it's going to be, as you said earlier, you're going to graduate. Also, if you stop eating, if we stop procreating or engaging in the act of procreation, it won't take but a generation or so and a generation and a half. And there you have it. End of humanity. So, there the thinking is just buying the things that people absolutely need just in order to get by day to day. And how much attention does somebody pay to, you might buy a bottle of XYZ cleaning detergent, and the bottle's this big, and it costs, $3. And the next time you go buy it, the bottle's this big, and nobody even notices or pays attention. But
yeah, for those of you listening, Bernard is making his fingers be one size and another size. So
yeah, smaller size.
Let's just say, it goes from an 8-ounce bottle to a 7.1% or a 7.1 ounce bottle.
Right. But the price didn't change. And the other thing I've seen, which I think is just you can't beat these guys. Oftentimes you'll open up the tube or the container of something, and you'll see that the hole in, for instance, in a soap dispenser, the hole just gets ever so slightly bigger. And you look at that and you go, wait a minute, so that means that every time I squeeze that container, just a little bit more soap is coming out, for sake of discussion, or whatever it might be. And you come to realize what they're doing is they're shortening up the replacement cycle.
Yeah.
So whereas before, you might get, 1 month of X amount of squeezes out of it, you make that hole just a little bit bigger, and suddenly you're only getting, 3 weeks and 5 days. Now nobody's keeping track of it. You really got to be detail oriented.
But let me wrap this into, because that strategy, a dividend portfolio that is spitting out, it's an equity-based portfolio that spits out dividends and has a propensity, but not a guarantee, to raise dividends over time, has volatility. So the capital definitely can go up and down because, let's say, pick a consumer staples company. Won't name names because we don't want to be in recommendation mode here. So, but let's just fill in the blank for the playbook company that maybe manufactures facial tissue or diapers or something. Mm-hmm. If that company stock goes down 23%, that's going to have an impact on the value of your portfolio. But what's fascinating is that they've shown a really resilient way that the dividends don't change. So if that same stock was paying a $1 per quarter dividend and it drops 23% in value, it doesn't move the dividend in cash. Like that dollar dividend is still a dollar dividend, and that's still what's coming off of the portfolio. And it's what you can spend. And then there's a really good chance historically, again, not guaranteed, but historically that dividend might go to $1.05 a year from now, or $1.07 or some other issue, and raise the dividend. And this can be really almost independent of what the stock price is. Yeah. So in the annuity solution, you've coached your clients, and we have as well, that these income guarantees come at the expense of eating your own principal. So the principal really is not going to survive long term.
No.
And you see, let's say you have an account that's going to be $250,000 headed toward 200, headed toward 150, headed toward 80, and it just accelerates as it runs out of money, as it continues to make these payments. So you counsel your clients that that's okay, because, we're going to run out of money, but not run out of income. The insurance company is going to step in and continue to make the premium payments, the income payments. And then maybe you wrap into that the life insurance program. So there's a legacy payment that endows to the beneficiaries on a tax-free basis at death, which is great. In the income portfolio that we built, we have a growing income stream that's coming off of the dividends. Again, these are not guarantees. And then we have a principal balance that is unknown, but won't be zero, because we don't think that every position in the portfolio can go to zero. And when the person dies, that portfolio receives a step up in basis and would transfer to the beneficiary's income tax free and not estate tax free. So there is an estate tax potential, which is, again, something that can be dealt with life insurance. So I think we do approach some of these problems similarly. Your approach is the safest of the methods, but I think we might have potentially a better, let's say, a rising income. That's kind of tough to do. The rising income story, those are hard to find in the insurance business, right?
You mean as far as annuities providing rising? No, no, there definitely are products that do increase income. You just take less. You take less in the early years.
Right. So you leave some on the table, sure. Okay. Right.
Again, I'm not into those because, just like this says, I'm all about guarantees. I want my clients to know this is our worst case scenario.
Yeah.
It will never be less than this, right? It just like, we talked about, there's different annuities, there's different life insurance. There is life insurance that have no guarantees, whether it's indexed universal life that participates in the index or variable life, but those don't have guarantees. So those that get everything. I can't do variable, but can I do indexed universal life? Is there a situation? Possibly. Yes. But it all goes back to, I want to make sure my clients understand this is our worst case scenario.
Yeah.
Right.
It's just setting a baseline. Essentially, what you've done is you've set an absolute baseline of of income.
Right. Because the clients in retirement, I always have people come into me saying, well, what's my return? What's my return? The second half of the baseball game is not about returns, right? It's about cash flow, right? But that's all they know. So, again,
one of my favorite expressions is actually, if you think cash is king, you haven't met cash flow.
That's right.
Correct.
Because cash flow is the winner. Yeah.
It totally is. So, so it's just, all I'm doing is educating people, right? And I tell my clients, I will not be your best salesperson because I'm not a salesperson. I'm an educator. I want to educate you on things that you don't even know about and why these fit your situation. And then I want you to buy something because you see it solves your problem.
I would have to imagine with the rising interest rate, Michael, I'd have to imagine with a rising interest rate environment, it's made the income opportunities even more, more lucrative for clients, I would imagine, compared to, 2, 3, 4, even a year and a half ago, because all the insurance contracts are based on what the 10-year treasury, I believe. They're all tied to that. And, we've seen rates go up there as well. So that plays nicely into people coming to you now who want to get even more income, I presume.
Well, yeah. I mean, I always tell people, right, I have a cookie jar, but nobody knows Michael has a cookie jar, right? It's always about how do I find the people that need the help or want the help, more importantly, right? That's always been a struggle.
Well, I think in our role here in the Know Your Options podcast is we also struggle a little bit with that sort of lack of understanding that there is this thing called an option or derivative that is like the Swiss Army knife of financial products. It can take an otherwise super volatile. Well, it is in itself volatile, but it can be managed in a way that can deliver some really extraordinary results. And Michael, you've taken the approach that the safe money insured guarantee is a very understandable thing that you're educating clients on and applying it appropriately. We're taking the same approach with maybe the most volatile product, but trying to achieve the same thing, which is interesting.
Here's one interesting thing is, like we've talked about, most people have their money at risk, right? Majority of their money is at risk, except what they have in the bank, which is there a risk at being in the bank? Yes, it's not making money. And now we have this new level of risk. Will my money be there when I need it? First of all, banks don't have your money, guys, right? Yeah. Banks don't have the money. Insurance companies have the money. For every dollar they insure, they have to put $1.08 to $1.10 in reserve. So if there's a run on the insurance companies, they have the money to pay out all the cash value. Okay. Banks don't have your money. So I don't remember where I was going with that, but yeah, I don't know. You mentioned something. I can't remember what you were talking about. Sorry.
It's basically, we're just taking the same approach. We're looking for the same thing, which is basically a control of risk. You've taken the absolute approach, which is using the insured products, and we've taken kind of the far right approach of using really volatile products in the form of options to try and achieve.
But blending it in a very, very finite amount.
Yes, right.
Teed up with treasury notes, which again are coming back to that rising interest rate environment, which benefits your income guys. We benefit from that because we're able to either put on more risk and get more participation, and or take less risk and get similar returns to what we were getting before. So it's in terms of I think we both benefit from the higher interest rate environment, and given that our stuff is very liquid, we're able to be very responsive to the rising interest rate environment, which we find very attractive. Right. Within reason,
I do remember what I was going to. We can put all our money at risk, technically, in the market. Yeah. Okay. Here's the thing. Insurance companies won't let us put 100% of a person's money into safe money alternatives. Think about that. We can literally go to the gambling casino, gamble our retirement away, but we can't protect 100% of our money in annuities, right? There's other vehicles that I use, life insurance, but you can't put 100% of your monies in annuities to make it safe, to give you guaranteed income for the rest of your life, because we have to have liquidity outside of those annuities, even though they're generating income. the other thing is, I'm always upfront with clients, we talk about financial advisors, right? How do they get paid? Well, they get paid off your account balances. I don't get paid off my clients' account balances. 100% of their monies go into their plan. Insurance companies pay me. And it's not on an annual basis. It's not like, being paid on a person's balances quarterly or annually. That comes out of their account. Okay. I have to get up and go to work every day because I can't sit back and just relax knowing I'm making money off my clients' accounts because I don't participate in that. And people aren't aware of that, or they don't realize how much they're paying in fees, whether it's the advisor's charging a fee or the insurance company is charging, the financial company is, has their fees in that. So, but yeah, the whole thing is you can't put all your money in annuities. Bottom line.
Interesting. Well, listen, we've spent a good amount of time together, and Michael, you're available. Do you have a website, or how would people reach you if they would? Like
I do. It's actually in the revamping, but it is safemoney123.com.
Okay.
Is the best place, and yeah, and I work in. I'm not just tied into one or two states. I'm licensed in other states. So if I have a client that needs help and they're in another state, it's very easy to get licensed in another state.
Yeah, exactly. All right. Well, any other questions or thoughts or a thing we should have asked?
Oh, I appreciate. Right. You guys educating myself on options a little. So it's a little more clear. And that I think it ultimately comes down that we're trying to do the best for our clients and put our clients not as much, so they're not at risk as much in your situation. And that, so I think that's, we're kind of in the same wheelhouse on the risk side, because you've limited the risk of clients, where I've eliminated the risk as much as possible, not only on financial, but in other areas, right? And that, so no, I appreciate you guys taking the time and having this discussion. And thank you very much.
Thank you, Mike.
You bet. Our pleasure. Thanks very much.
Thank you.
This interview also may contain statements that constitute endorsements of measured risk portfolios, also known as MRP. Please note that any such statements are not made by clients of MRP, but by representatives of other investment advisory firms that work with MRP. No compensation was offered or given in exchange for these statements. However, a conflict of interest exists due to the incentive to give an endorsement in the interest of a good future working relationship between the endorser and MRP.